want to start with the one idea that governs everything we do. We underwrite every loan as if there is a significant chance we could end up owning the property ourselves. That may sound overly cautious. However, once that becomes your starting point, every decision that follows gets sharper. You stop asking, will this loan probably be fine? And you start asking, if everything went wrong, would we still be protected? Let me walk you through how we evaluate a loan, layer by layer. It all begins with value. Everything we decide afterward depends on getting this one calculation right, since the size of our loan is set as a percentage of the property's value. If we get that value wrong, every decision that follows is built on a bad foundation. So we are very careful here. A loan usually comes to us in one of two forms: either an acquisition where someone is buying a property as it stands, or an acquisition with construction, where they buy a property, add value, and plan to sell it. In both cases, our job is the same: lend on an accurate value. We start with our own internal market research using the MLS and a range of valuation tools. But we never stop at our own opinion. We require a third-party independent appraisal on every loan we do. We do not rely on a borrower's numbers. We do not rely solely on our own. In practice, we lean hardest on a sales comparison approach, and the emphasis there matters. We care more about comparable properties that have actually sold and not just what is currently listed. A listing is only an asking price. A sale is what a real buyer was actually willing to pay. And we look for properties that are similar in size, type, finish, and specification. And we use those real sale prices to determine what our property is actually worth. When the property already exists, that is the more straightforward case. We can inspect it, have it appraised, and bring in a property inspector if needed. When it is a construction loan, we have to put a value on something that does not exist yet. And so we look at the area, the building plans, the specifications, and everything that goes into the finished product. And we determine what that property should be worth once it's complete. Either way, we end up with a valuation that we trust, and that value drives everything. Once we have that value, the next decision is how much we are willing to lend against it. This is called the loan-to-value ratio, and it is where a lot of our protection comes from. Our maximum in the Investor First Fund is 70%. For example, on a property worth $1 million, we would lend at most $700,000. That means the borrower has to bring the other $300,000 themselves. And here is why that matters so much. That $300,000 of the borrower's equity sits underneath our loan, and it absorbs the first losses if the property declines in value. At a 70% loan, the property would have to fall by 30% before our principal is even at risk. And when we underwrite lower than that, at 65 or even 60%, which is our target ratio, that cushion of protection gets even larger. The lower we keep that ratio, the more protected our investors are. And that is why we are always trying to lend less and not more. Now, that equity cushion only helps us if we can actually turn the property back into cash. Because if a loan goes bad, the way we recover our money is by selling the property. So before we ever lend, we have to ask a simple question: is there a real market for this property? This is where we look at marketability. Is there too much inventory in the area, or is the property scarce and in demand? Does it fit its neighborhood? Are they building too large a house for that area, or finishing it to a standard that does not match what buyers around it actually want? We want genuine product market fit, because a property that does not fit its market is a property that is hard to sell. We also look at the property itself. Is it on a busy street, at a bad intersection, or next to something that would push buyers away? Anything that would slow down a future sale goes straight into our underwriting, because a slow or difficult sale is exactly what we want to avoid. This is also the clearest and most common reason we decline loans. When we have real doubt about marketability, we say no. If the location is not right, if the neighborhood is not ready for a brand new or oversized property, or if it sits in a heavily commercial or industrial area, those are examples of red flags, and we walk away. A good loan ratio on an unsellable property is still a bad loan. Everything I have described so far assumes the worst case. However, the best protection of all is making sure the worst case never happens. A loan that simply performs, where the borrower makes every payment and finishes the project on time, never touches the equity cushion, and never needs to be sold, that is the goal on every loan we fund. And it is why the borrower matters as much as the property. We look closely at who we are lending to. We look at their credit score, their borrowing history, and their track record. How many projects has this borrower completed? Are they an experienced builder? Have they bought and sold properties like this before? We look at their current portfolio, how much they owe, what their monthly obligations are, and what their income looks like. We must have answers to 3 questions. First, do they have the financial capacity to carry this loan and make the payments through the full term? Second, do they have a real track record of buying, building value, and successfully selling, having paid off their previous lenders along the way? And third, if the property produces income, do they have the experience to manage it, maintain it, and collect rent? We are not looking for a borrower trying something new on our money. We want to lend into a process this borrower has already proven that they can execute. And there is one more layer of protection on every loan we make. The borrower personally guarantees it. So beyond our first lien claim on the property, we also hold a personal guarantee from the borrower themselves. That means even if a default or recovery is not limited to the property alone, we can pursue the borrower personally for what they owe. It is one more reason a borrower thinks twice before walking away, and one more layer of security for our investors. The last thing we do is step back and look at the project as a whole. Does it make sense? Is the neighborhood ready for it? Does the borrower's exit strategy actually hold up? Can they realistically buy it, build it, and sell it within the loan term, which is typically 12 months? Then we come back to the question we started with, the one thing that governs everything. In the worst case, if this loan defaulted and we ended up owning this property, would we be comfortable owning it at that price? If the answer is yes, the value is solid, the cushion is there, the property is marketable, and the borrower is proven, then the loan has cleared our underwriting. That is when we deploy capital, confident we will have payments coming in, strong collateral beneath us, and a good outcome for the borrower and for our investors. That is how we underwrite. We start with an honest value. We lend conservatively against it, and we make sure the property can be sold. We lend to borrowers who have done this before, and we only move forward on projects we would be comfortable owning if we had to. Each step is a layer of protection, and a loan has to pass through all of them before we fund $1. That discipline is exactly what stands behind the steady returns our investors have received for over 19 years. If you have questions about our underwriting standards or the guidelines we use for a specific area or type of project, we welcome them. You can reach us at stallioncap.com. We look forward to working with you.